Right now at 4:30, we continue to follow those stock markets worldwide. They just plunged. Here's a look at where things ended on Wall Street this afternoon. Look at this, 900 points down right now. And there is new concern about a recession. No one wants to say that word. Joining us now to break down what all of this means is certified financial planner Joel Johnson with Johnson Brunetti. Thank you for being here, Joel. I appreciate it.
Great to be here, Stephanie.
All right, so let's start off. We are entering what is known as a bear market. Can you explain what that means?
Sure, a bear market, and people can debate what this means, but in a real simple terms, it's when the market goes down 20% from its high, and we're down over 20% from the high of what's called the S&P 500 right now. And it just means from the top, which is just before New Year's here, to the bottom where we're at today, the value of most stocks are down about 20%, some more, some not. And obviously that affects our 401ks. It affects any kind of savings we had for children's education or for buying a home or so on. So big concern for Americans. Some people pay a little too much attention to the stock market, but we should pay attention this year because it's changing a lot of things.
Yeah, of course, it's your money. Of course, people pay attention. So when you say it's down 20%, historically, do we typically bounce back from this? I mean, what does history tell us?
Yeah, we do. Americans have a short memory. They say about every 3.5 years, we see a downturn like this, and the market goes down somewhere around 20% or so. Sometimes the bounce is real quick, Stephanie. We saw that back when COVID hit. There was a quick bounce back. The market went down actually about 30%, bounced back in a matter of a month and a half or so. And so we may see that here. The problem here is there's systematic underlying issues with the economy. Everybody agrees now that the Fed was too slow, our federal bank was too slow in raising interest rates to slow down the economy. And now they're really playing catch up, which means they've kind of got to hit it with a sledgehammer instead of a fly swatter. And so the fears about recession, which you mentioned earlier, are there because when interest rates go up too quick, businesses stop spending money, people stop buying homes and so on, and it really slows down the economy. In the long run, that's what we have to do, but sometimes there's that short-term pain to get things back to equilibrium.
All right, so you said recession, you said the R word. So what is the likelihood that that happens? Could it happen?
It's pretty high right now. And sometimes that word, people don't quite know what it means, but it just means the economy will contract over 1 or 2 quarters. So it just means things will slow down, hiring will slow down. There might be some layoffs, unfortunately. So we've got to, be aware of that. But it probably will happen. I would put the odds at more than 50% will go into a recession. The key now is, can the recession be short and can it not be too deep? And so that's the important thing. And, folks, if they have any control over their money, over their budget, they need to have a little bit of an emergency fund here. They have to be real careful about going into debt with credit cards. You want to have as much of a cushion as you can. I realize that's hard for some people. Some of our viewers, are just making ends meet, but we've got to be careful about taking on debt. This too shall pass. It's a matter of how long, but most bear markets, Stephanie, they correct themselves on average in about a year, a little bit more than a year. So we've just got to kind of get through this tough time.
All right, wait through it. Thank you. Joel Johnson from Johnson Brunetti. Appreciate it.
Thanks, Stephanie.